get reduced from the enterprise value to come to the equity value. Another thing that I would wish to inform you, as most of you know, Burger King India went public in December, and at that time we had raised a primary for expansion of our Burger King India business. So that money that we had raised will be utilized for the expansion of the India business. Should we go through with this transaction, subject to the due diligence and all the other efforts that the internal team will make, we have a 90-day exclusivity on the transaction, and subject to everything going through and further subject to the board and shareholder approval, should we decide to go ahead with this transaction, we will at Burger King India need to raise further equity capital, which will be in the range of anywhere between $180 to $200 million, depending on our renegotiated or the negotiated price that we do, and subject to board and shareholder approval. Friends, this is prima facie on what we bid, how we bid, the EBITDA basis are bid. What I will do is, there was a link mentioned in the exchange notification giving you insight about the Indonesian business. But because it was too short, I am sure a lot of you would have gone through, some of you may not have been able to. I will hand it over to Raj to take you through prima facie why we find this business very exciting, why are we all very excited about this opportunity, and after that we will take on the Q&A. Over to you, Raj.
Thank you, Prashant, and thanks everyone for joining in on very short notice. I hope you're all doing well and getting yourself vaccinated to stay safe, and mask up and sanitation as we have been talking about. So good luck on that. And just real quickly, I wanted to share, our vision has always been as a company to be the largest QSR in this kind of a geography, Southeast Asia geography. And so we started, we're building a platform on which, we will continue to grow and become a large QSR. Now, when we say large, we just don't talk about number of restaurants that we open, but we are very specific to two numbers, which is, one is what kind of sales we are generating, what kind of business revenue we are generating, and second is what kind of cash flows coming out of this business, what kind of EBITDA we are generating. Those are the kind of parameters we measure, ourselves on. It's not just, open more and more restaurants, but profitable restaurants. We also, in our vision, believe in only going with global brands. So, you will find that, Burger King, as we have done here, and the consideration of Burger King Indonesia, which is this familiarity of not only the brand, but in a minute I'll tell you about the market as well. So those are the visions and the way we look at it in building this business. Why? Because this business, as I've said in the past when we are doing the IPO and on road shows, is a business of scale. And if you build a large scale, then you amortize your, G&A and admin, expenses over a larger number of restaurants, which means increasing cash flow and profitability at the company level. So that's why we continue to build this around the world, and here this is a great opportunity for us to do this in our market. Now, moving away from strategy, why strategy, we go into the market attractiveness. So if you look at the market, Indonesian market and the Indian market, both these markets have a lot of similarities. One is a very, very young millennial population. In fact, 60% of the people in Indonesia are below the age of 35, right? And these are the people, as we understand in India as well, are the ones that are eating out more often, right? So it's a massive, comparable in both these markets. Both the markets have very similar kind of, clientele. Burger King, as you know, as a brand, is positioned with millennials. So our communication, our product, our efforts are all around millennials. Now, out-of-home eating is growing. We all know that. There's several reports we can go into and so forth. But if you consider that, between India and Indonesia, if you do go through with this transaction, we do take over Burger King India, we will control, or we will be serving Burger King products in 20% of the world's population. Indonesia being the fourth largest country in terms of population in the world, right? And the per capita is twice what it is here in India. So it's a very, very good lucrative market. And this is the reason that we as a company took some very serious notes into this opportunity. Now, just about the business, if you look at the business of Indonesia, today we sit at about 174 restaurants and supposed to end the year, calendar year at 185 restaurants. If you see the efforts of the company in the last 5 to 7 years, they've moved their business significantly from what used to be a mall-based business to a freestanding drive-through business. We call it FSDT. And FSDT restaurants are significantly more profitable because they drive higher revenues and higher tickets and higher number of checks through those restaurants. In fact, if you look into the details of the document uplinked, you'll find that the rents over there in Indonesia are significantly lower than the rents here in India. In fact, the gap is almost to the tune of 8 to 9 points. So a significant inherent advantage that you have in that business there that you acquire if you do go through with this transaction. They're also, in spite of the fact they run a higher ADS, if you look at the pre-COVID numbers, they do drive a higher ADS, which is driven by a higher check than Burger King India. So it's a business that has a higher revenue per restaurant and a higher EBITDA at the restaurant level as well as the company level. So it's a very profitable, lucrative business that we are looking at. Now, just coming back very quickly to the opportunities of that business, right? If you don't see the opportunities, what are we doing, right? So the opportunity is, today you see our GP gross margins in India. We have moved these gross margins over the last 7 years from where we started at 55, 56%, to now at about 65%, and the journey forward to move to higher numbers, right? That is the big opportunity there as well. And their GPs right now run significantly lower than our business here in India, and there's a massive opportunity for us as a business. The second opportunity that we really have over there is and this is basically to drive gross margin, it's a big chicken market. And right now, we have the opportunity to skew our menu, which is what we call menu architecture, towards more lucrative, high margin products, which is the chicken. You'll see if you do get in there that, how we do that. And you've seen that already in India. Also, the barbell strategy, we keep talking about it. We have, mastered that here in India, done a great job by driving value on one side and premium products on the other side, which gives you a very rounded, profitable gross margin. So all these, things are there. And what is great on the other side, these are opportunity areas. The strengths over there is we have a very, very strong management team in place. In fact, this management team took these restaurants over in 2014. There were only 37 restaurants in place at that time, and then started growing the restaurants with some very strong leadership in both development and marketing and leadership roles. So that, is done not only just by growing, but profitably growing, but they've also, like Burger King India, has won a lot of operations awards and recognitions in the past 7 years for what a fantastic job they've done in terms of taking operations to a whole new level. So these are some of the business, making short so you have time to question us. But higher ADSs driven by higher checks, a little bit of opportunity in driving more traffic, great freestanding drive-through locations, which started building in the past few years, and a massive opportunity. The infrastructure, by the way, is better suited and better ready for freestanding drive-through restaurants over there. In India, we're moving at the pace the real estate is developing, but there the real estate is more available, and the pipeline for freestanding drive-through is much higher. So that's the other advantage of building more and more freestanding drive-through restaurants. GP opportunities, I told you that a gap we need to narrow. Now, EBITDA margins, I spoke about company level EBITDA margins. I just want to take a few seconds over here just to give you some synergies. You know, when you put two little companies together, you put two markets together, you do that with a plan that there's going to be synergies, there's going to be things that you can share, and there's going to be advantages to you as a company. So we have built a fantastic technology base here in India when it comes to consumer-facing technology facing the restaurants, technology facing the management, and technology facing our vendors who we call supply partners. And that technology was built, in 2014-15 with a view of 2,700 restaurants, and we are sitting at 260 restaurants, right? So there's a massive opportunity, massive headroom over there for us to accommodate and spread that love between the two businesses. Back of the house, extremely strong, again, built to capacity, built 700 restaurants. Supply chain and CapEx, these are other synergies we look at when you're buying, equipment, when you're buying, food products, when you're buying, furniture. There's a lot of synergies, when you're buying for X number of restaurants or X plus X number of restaurants. So a lot of these synergies as well that come together. So this is the excitement that we see in considering this business. And we as Prashant just said, are just in a non-binding offer stage. We will start due diligence and digging in further into the business. But I stay, extremely excited about this. Over to you, Prashant. Thank you, guys. And I'll be here for all questions.
Thank you, Raj. So as Raj mentioned, we've submitted a non-binding offer. We have an exclusivity of 90 days. During this time, a lot of work will be done by the team to go and do the due diligence, and a lot of work on the synergies that Raj mentioned. And subject to all that work happening, and if the board kind of accepts it and we go ahead, then we will go ahead and raise capital as well. So friends, with that, we will open up the floor for Q&A. Would request if you guys have any questions, feel free to ask, and to the best of our ability, we will try and answer them. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, you may press star and 1. The first question is from the line of Percy Panthaki from IIFL. Please go ahead.
Hi, sir. Just some clarification on the numbers. You mentioned that the acquisition is at single-digit EV/EBITDA multiple, but if I look at your 2019 company EBITDA, it is 12 million, and your purchase price is 183 million. So that comes to approximately, it's definitely higher, right? It's around 15 times.
Okay, Percy, two things. One, I mentioned that we are buying this at a single-digit FY23 EV/EBITDA, and I'll help you do the math. So I think it's a fair point that you picked the 2019 number. So if you see in the same presentation by FY23, the company is supposed to have 225 restaurants. On that 225 restaurants, if you put the ADS that the company achieved in 2019.
Mr. Ramesh Shah? Hello? Mr. Ramesh Shah? Is anyone connected? Hello? Mr. Ramesh Shah, can you hear me? This is the operator. Mr. Ramesh Shah, if you can hear me, please respond. Hello? As there's no response, I'll join you back.
Remaining 15% is going to remain with whom, and does that also come to you over a period of time?
So, great question, Percy. So if you go through the announcement, you will see F&B Asia Ventures owns 65.79% stake currently in Burger King Indonesia. The balance stake is held by an Indonesian partner, called Mitra Adiprakasa Group. They are one of the largest retailers there in Indonesia. When we acquire, and it's their decision how much they will probably give us. But our understanding is we are currently bidding for up to 85%, which is some of their Mitra Adipakasa's stake will come to us, should we choose to go ahead with this. Balance 15% they will continue to own, and as we continue to grow, the decision would be theirs to sell. And obviously, as part of the negotiation on shareholder agreement, we will have the right to even purchase that at that point of time. But as of now, our non-binding offer is for up to 85% of this, plus this our stake will go up as we put further primary capital into the company for expansion.
Okay. And pardon my ignorance here, but F&B Asia, is that company, is it a private equity held company? What is the background of this company?
Yes, it's so if you go back one step, even at Burger King India, F&B, we also have QSR Asia. QSR Asia is in turn held by F&B Asia Singapore. This is a similar business, F&B Asia Ventures. If you remember when we had done the roadshow, we had said that besides Burger King India, F&B Group also owns Burger King Indonesia and Domino's Indonesia. So yes, there is a common promoter over here, which is also mentioned as part of the release to the exchanges. You are right, Percy.
Okay. So while you are buying this stake, ultimately you are owned by F&B Asia. So F&B Asia is not really getting rid of the stake. It's just sort of rooted to them in some other manner. So just what is the rationale behind this deal?
So the rationale behind is F&B Asia, being in turn held by a private equity fund, have their own considerations when they choose to exit businesses. Because they chose to exit the Burger King Indonesian business, maybe because of their fund life, they went out and invited people to participate in that. And one of those non-exclusive invitation was also given to Burger King India, which when we evaluated and what we liked, what we saw is after taking the consent from the board, we went ahead and offered a non-binding bid for the same asset.
Okay. Understood. Yeah, that's all for now. I'll come back in the queue if I have more questions. Thanks.
Thanks, Percy.
Thank you. The next question is from the line of Deepak Gupta from Reliance Nippon Life Insurance. Please go ahead.
Hi, thank you for taking my question. I just wanted to understand again on the rationale for the Indian entity to acquire the Indonesian operation, given the fact that there's so much of opportunity available in India at present and we are going through pandemic, so things are pretty uncertain. So why would Burger King India look to expand into Indonesia at the time when there's so much uncertainty in the environment?
Right. So 2-3 reasons, Deepak, which Raj kind of highlighted. I will reiterate that to you. One, our vision at Burger King India is to build one of the largest QSR vertical or platform in India. That's first point. And when we say largest, it's not in just terms of number of stores, but in terms of revenue and in terms of profitability. So that's first point. Second, when this offer came to us, what we liked about this is the opportunity which the country represented. If you look at the burger QSR penetration in Indonesia, it's still in its infancy over there. Second, what we liked was the team over there. You met some of my colleagues over here in Burger King India. They have a very strong management team with a multi-year QSR experience, which meant that I would not have had to stretch my bandwidth in India to do that. Third, if you see me, I'm not buying or I'm not going ahead and starting a greenfield kind of an expansion in Indonesia as a market. Fourth, for all the opportunities that Raj mentioned, one, we bid for this asset, Deepak, at a very, very attractive price, single-digit EBITDA. Plus, we see a lot of low-hanging fruit, whether it's the gross margin that Raj spoke about, the company's now renewed focus on opening and expanding through freestanding drive-through. They have still not opened cafes. When you open a freestanding drive-through, it's a 24-hour operations. Breakfast will come over there. Currently, the chicken, in terms of the contribution to the entire product mix is very low. Indonesia is predominantly a very large chicken eating market. They probably eat chicken for breakfast, lunch, and dinner. As we go there, and then some of the work that they have done and our ability to add value on the chicken product is going to be very interesting. Last but not the least, if you see the delivery and the digital business in Indonesia is significantly far more attractive than what we are currently seeing in India. It would be about 30% of their business pre-COVID. But the way the business is structured over there, the commissions that they pay to the Zomato Swiggy equivalent over there in Indonesia is sub 10% compared to what we pay over here. And if you kind of put all of these things into perspective, we at Burger King India feel it's a great opportunity, because of the management team that we have.
Yeah. And just to add to what Prashant was saying, we're not going to stop growing here in India. We have a fund raised and we have money here that is stipulated to grow in India. We have a team in place. We have MFDA agreements with our franchisor. We're going to be building 700 restaurants by December 2026. We will have 700 restaurants at the end of that tenure. But by this purchase, can you imagine that you would be over 1,000 restaurants if we follow the MFDA of that country as well as this? So, there's a famous saying, walk and chew gum at the same time. This is not exclusive. We don't need to just do one. We can do both. Give you a little background on myself. If you look at my past, you will see that I was based out of London, running the Northwest Europe business, which had multiple countries, multiple different languages, multiple currencies, and in that environment, we were building restaurants all across 9 countries at that time. So this is something we do. We want to build a vast. It's a scale business. It's a business about building a nice platform and we bring similar businesses, familiar businesses. We don't try to create brands from scratch. We're taking over brands. Burger King is a great brand, and we are going to build a great business with that brand. And that's the way we approach it. And so it seems like this is a great opportunity for us. We will do our due diligence, and that's where we are kind of seeing this moving forward. Obviously, we have a fantastic board of independent directors that help us in guiding our decision making here in India.
Sure, I hear you. My next question is about funding this transaction. Are you all open to the idea of leverage buyout, given the fact that the transaction is quite large and it will imply a meaningful fundraise if you're looking to do it only for equity?
You're right, Deepak, but we are not very big fans of leverage. Again, this will be a decision that we will take in consultation with our board and our shareholders. But as management team, we prefer the equity route. It will be a meaningful dilution, Deepak. You are absolutely right. But we are also buying a very large, meaningful, and fast-growing asset. And that's currently our point of view. So no, we will not be taking on leverage to acquire this.
Sure, I hear you. Thank you. Thank you so much.
Thank you.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Shivam Bajaj, retail investor. Please go ahead.
Hello.
Hi, Shivam.
Hi. Good afternoon, sir. Am I audible?
Yes, you are.
Yeah. First of all, sir, I am a proud shareholder. Today only, in fact, I've added Burger King into my portfolio. And to this call, it's a very delicious share to have in my portfolio. My question here is, first question is, how much reserve do we have in terms of the acquisition for the Indonesian business?
Shivam, as I mentioned, we are not utilizing any amount that is currently lying in our reserve in Burger King India to acquire the Burger King Indonesian business, point number 1. Point number 2, as Raj mentioned, we still have 90 days of due diligence and work to do. Point number 3, subject to our board and shareholders' approval, we will require anywhere between $180 to $200 million to not just acquire this business, but to put further capital to grow the Indonesian business and the Indonesian market. All of this will be done through a new fundraise that we will do at an appropriate time once the due diligence exercise is over and subject to confirmation from the board and from the shareholders.
Okay, sir. Okay. And my second question is, I have read about the acquisition with Tim Hortons, the merger with Tim Hortons. So in the future, anytime Burger King can expand the Tim Hortons presence in India?
So if you will, if Shivam, you will go through our previous two conference call transcripts, you will realize that we have already announced the launch of our own cafe within Burger King India stores. So we already have cafes. So from that perspective, I don't think Tim Hortons is a attractive proposition from our perspective.
Okay, sir. Okay, and one last suggestion I would like to give is if we could offer, to some coupons to the shareholders also in future.
Sure, Shivam. This was a suggestion made by a lot of shareholders at our AGM. The board has taken note of it and we'll come back to you, Shivam.
Okay, sir. Okay. Thank you so much. Thank you so much for letting me speak.
My pleasure.
Yeah. Thank you, sir.
Thank you. The next question is from the line of Amnish Aggarwal from Prabhudas Lilladher. Please go ahead.
Yeah. Hi, Prashant. Congrats on the acquisition. I have 2-3 questions. First being in the PPT, am I audible?
Yeah, you are, Amnish. Go ahead.
Yeah. So you have given the store level EBITDA and company level EBITDA numbers up to, say, 2020 and first half 21. So can you share with us the numbers below that, say, your depreciation, your interest burden, which is there on company debt, and where does the PBT of that company stands?
Okay. So, Amnish, we have currently shared the data that has been made available to us. As we are saying, we will now embark on a detailed due diligence exercise. Currently, those are numbers we will share with the broader market at a later point of time. But this is a primarily cursory view of the business and the numbers. So you'll have to be a little patient with us for the next 60 days as we complete our due diligence, post which we will share all these details with you.
Okay. Now, my second question is that if we go by the total cost of acquisition is 183 plus 40. 40 which will $40 million we will invest to grow the business, and 183 is the base cost. So the total to us will be around $223 million. Is this judgment right?
No, Amnish. As I mentioned, the initial 183 million is our non-binding offer on a cash-free, debt-free basis. Currently, the debt would be in the range of about $25 to $30 million. So if you reduce that, the equity value would be roughly about $155 odd million. And if you go through the announcement, we are acquiring up to 85% of that. So that number would be somewhere in the range of about $130 to $135 million. Over and above that, we will require about another $40 million for the expansion of the Indonesian business.
Okay, understood. So that is really helpful. The second question is slightly, I would say, strategic. So you are saying that in 4Q 21, they will be launching the breakfast menu as well as the cafe. So is it calendar year or financial year?
Sir, I didn't say Q4. What we are saying is that cafe and breakfast is on the card. See, all the freestanding drive-thrus that they have, both breakfast can get into there very easily. They are almost in the verge of launching that. Cafes will also start. A lot of initial work is going. So Q4, when it comes to FY21, to your question, is the India Q4, which is the Jan, Feb, March. Sorry, it's the calendar Q4. Sorry.
Okay. Understood.
But Amnish, one clarification on your first point. We have still not acquired Burger King Indonesia. They have accepted our non-binding offer. They have now given us 90-day exclusivity to do all our work. And then, we will put in our final binding offer for the acquisition of that. So I just wanted to kind of correct you on that.
Yeah, absolutely. And secondly, you see, when it comes to the chicken market, now their chicken product, is it different from the chicken product which other QSRs, whether it is you can say Burger King in India or McDonald's has? So
this is a very unique Burger King market, and it's unique because of some of the things we shared with you, which is it's a highly chicken market. The back of the house actually set up in a way wherein we actually build a product in the restaurant. The marination and the breading is done at the back of the restaurant. So it's a very fantastic product. It's a significantly higher quality product than you would get if you were taking a frozen product and then frying it. So yes, not only the opportunity to learn from the Indonesia business, what they're doing there and maybe even use that to our advantage here in India, but also to learn to take that menu and skew it so that it's a more balanced menu between the two proteins, so that we are selling more and more of chicken, which is considerably a cheaper product over there in Indonesia in terms of cost to the business, which will increase the gross margins in the business and get us closer to where we'd like to see.
Okay, sir, this is really helpful. And my final bit, you refer to the low charges they are paying to third-party distributors like Zomato and Swiggy, etc. So what sort of synergies can be expected over in India? And for example, there if the costs are only 10%, so can we see gradually the cost in India also moving towards that, or there is low probability of that happening?
No. So first of all, there's a massive difference, right? Their revenue to cost of distribution or using this delivery sales is about 2%. Ours is 7%. So there's a massive gap between the two, and this basically due to the maturity of that market with the aggregators. There's two very good companies over there, and there's upcoming budding companies, but they've been there for a long time, and they do more than just deliver products from QSR. They do a lot of things, and you can Google and see Gojek and Grab. These are companies that have been doing this for a very long time, right? So that's where the advantage is. See, the synergies come because we have an app, right? We have a Burger King app here in India. We have a team that built it. There's a team that built the Burger King app in Indonesia. What if, we are using the same synergies, right? We're using the same kind of, background, back of the house. We're using the same vendor for the technical production of these apps. We are using, the same promotion company. So there are a lot of synergies there that you will see advantages of in the technology side of the delivery business. But where it comes to logistics, they will continue using the companies that work there, and we will continue using the companies that work here. But if you follow Burger King India's earlier AGM presentation, we had outlined that our vision is to take, about 1/3 of the delivery business sales and put it into the Burger King app. So we want to do that Burger King sales. We have made significant progress in just after launching the app very recently, have 1 million downloads of the app. We are shifting a lot of that sales onto our app. And we'll continue doing business with aggregators, but we think in the long run we should have a balance between aggregators and our app. And that kind of synergy will bring into, if you do take over the Indonesian market, we will carry the same kind of efficiency into that market.
Okay, sir. Thanks a lot.
Thanks, Amish.
Thank you. The next question is from the line of Suraj Navandar from Sampada Investments. Please go ahead.
Hi, sir. All my questions have been answered. Thank you.
Thank you, Suraj.
Thank you. The next question is from the line of Percy Panthaki from IIFL. Please go ahead.
Hi, sir. So I was just looking at your P&L which you have given and the number of stores. So if I take the average number of stores for 2019 and $100 million of revenue, the average sales per store comes to roughly about 5 crore rupees. Which pre-pandemic in India, I think your average sales is around 4 crore rupees. So given that it's a chicken eating country, they are eating chicken breakfast, lunch and dinner, only 20% higher sales per store, doesn't that seem to be, the store efficiency seems to be poor given the cultural context.
Percy, as Raj mentioned here, that business is just the whole QSR, burger QSR piece in Indonesia is just taking off. Also, if you see our ADS, pre-COVID was about 110,000 rupees. If you see the math that they've mentioned on the same page, their ADS is 1,900. So on that basis, if you see, it will be about 145 odd thousand in terms of ADS. So it's about 30-odd%, 30-35% higher and not 20-25% higher. And as I said, there are massive opportunities, right? That is what keeps us excited. One, the fact that is predominantly in Indonesia, we as in Burger King Indonesia is still predominantly selling a lot of beef products. Chicken, we are just beginning to first make a mark. In this ADS, breakfast is not included. In this ADS, cafe is not included. So if you pull up all of this, one, you will get a direction. That's point number one. Point number two, if you see 2019 weighted average ADS of about $1,900, you will see my FSDT were only 58 at that point of time, and more restaurants were much larger. As we are moving forward, a large part of your incremental restaurants that Indonesia is planning to open are freestanding drive-thrus, and the freestanding drive-thru ADSs are much larger or higher compared to malls. So if you extrapolate this going forward, obviously the number will be higher. But yeah, if I am buying this business in a single-digit EV/EBITDA with an ADS which is about 25 to 35% higher than my India ADS, I will take that with the kind of opportunity that is there for me to further scale this up, Percy.
Sure. Makes sense. And secondly, I don't know if you mentioned this when I was browsing through the presentation, maybe I couldn't find it there also. But can you give us some idea on how many stores you plan to open in 22 and 23? And is this a calendar year company or a March ending company?
Yeah. So Percy, if you go to slide number 9 in the presentation, we are talking of about 330 stores by 2026. And if you look at our Burger King India MFDA target of about 700 stores by FY, same calendar 26 is what Raj was saying, that number will look northward of 1,000 crores for the combined company. But currently, that's where the company has currently, shared information of about 330 stores by 2026. And if you see the math the slide that you were talking, principally they're talking about opening about 35 stores every year. So currently the Indonesian business per se runs on a calendar year basis. Should we choose to go ahead and acquire this business, then this business will consolidate on a financial year basis from a India reported numbers perspective.
And it becomes the second largest.
Yeah. So what Raj is coming from is, if you are able to execute well both the India and Indonesian business, in another 2 to 3 years time, we will emerge as the second largest QSR brand in India, both in terms of revenue and EBITDA.
Right. And one more question on this valuation. You're saying single digit EBITDA, EV/EBITDA multiple for FY23. So how was this valuation arrived at? Was there a benchmarking study done for similar QSR companies in Asia Pacific? Or what was the methodology to really arrive at this valuation?
I will not be able to share everything, but Percy, I will share exactly what you are asking in that sense. So we appointed CLSA as our financial advisor and Pricewaterhouse as our valuation advisors. Both of them used various benchmarks, including discounted cash flow, including not just benchmarking the Indonesian business with the Indonesian listed QSR space, but also the broader FMCG players in Indonesia and at what multiples they were trading. Also, a lot of emphasis was given on some of the transactions that happened on the M&A side in the Indonesian market. They then broadly expanded this from Indonesia to Southeast Asia. So all of those were considered, and then a valuation was arrived at which our board felt comfortable to go and put in a non-binding offer. So not one particular metric, but all of these were put to test to come to what we thought would be a fair price to kind of go and bid for this asset, per se.
Okay. Yeah, that's all from me. Thanks.
Thank you. The next question is from the line of Sushruta Mishra from Kotak Securities. Please go ahead.
Yeah, hi. This is Shushruth from Kotak. Two questions from my side. What is the reason for lower gross margin in Indonesia? Are other QSRs in that geography operating at similar level of gross margin, or is it more due to the life cycle of the burger QSR industry in that market? This second question is the post IFRS 16 accounting similar to Ind AS 116? So the EBITDA margin that has been shared in the presentation, is it comparable to the EBITDA margin that is reported on post Ind AS basis?
So yes, answer to your second question is yes, both are comparable, similar to Indian adjustments. On the lower gross margin, I tried to answer that question previously, because they have a predominantly currently large part of their burgers being beef burgers, and beef in Indonesia is imported. As a result of this, the gross margins are currently low. As Raj was mentioning in his initial remark, that as more chicken makes entry into the menu and into the revenue, chicken is locally sourced in Indonesia, the margins have a potential to go up. Also, as you know, you keep scaling up the business, you will also get other synergies, but currently the gross margins are that because of beef being imported.
And if you look at where we were, right, when we started this company, 2014-15, we were sitting at very similar gross margins, right? So gross margin is not just an element of how cheap you buy or how much you sell for. There are a lot of things that go into gross margin, predominantly menu architecture. What is your menu? What are you selling, right? If you sell something at a low price and a higher cost, then you're going to have low gross margin. So a lot of things go into it, and that's what we have done in the last 7 years here in India to move the gross margin to where it is now. Moved it almost 8 to 10 points. So a lot of work is going to do the same things. But I think as Prashant summarized towards the end, it's a cheap chicken market where chicken is cheaper available. But our menu is skewed towards beef. So I think there's an opportunity to do it a little better over there.
Sure. Thank you so much.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1. Participants, to ask a question, you may press star and 1. The next question is from the line of Dheeraj Mistry from Antique Limited. Please go ahead.
Hi, management. Sorry, I joined a bit late to the call. But can I know from where we are likely to fund this acquisition? It would be from the debt or from the fresh issuance?
Hi, Dheeraj. Sorry, no need to be apologetic that you joined late here. We also gave a short notice, but we wanted to do this call and very excited about this development, so we wanted to share with all of you. So Dheeraj, we did mention early on that the fact that we are generally risk averse from taking leverage to buy a business. So if we choose to go ahead with this transaction, we will go ahead and raise equity capital at appropriate time, subject to board and shareholder approval. So the funding will be through equity and not through debt.
Okay. And given that $183 million is the enterprise value and you are acquiring 85% of the stake plus $40 million of infusion, so it's 183 plus 40 or 85% of 183 plus 40?
So I also shared that math. 183 I mentioned is the enterprise value, and our non-binding offer is on a cash-free, debt-free basis. From this, based on the preliminary information that we have to reduce the debt, which is currently $25 to $30 million. That will bring you to equity value of $1.5 billion for the entire business. We have currently put in a non-binding offer to acquire up to 85% of that. That would be somewhere in the range of $130 to $135 million. And over and above this is what we will raise primary of $40 million.
Okay. And this infusion will be for further expansion?
That's correct.
Okay. Thank you very much. That's it from my side.
Thank you, Dheeraj.
Thank you. The next question is from the line of Percy Panthaki from IIFL. Please go ahead.
Sorry, Prashant, one more question.
Don't be sorry. Please go ahead, yaar. Please.
So, just one question on the regulations of this transaction. So since the selling shareholder, FNB Asia, is also sort of indirectly a sort of promoter for Burger King, would it be classified as a related party? And if so, would this transaction require approval from minority shareholders?
So answer to both the question is yes, it is a related party. Because it is a related party transaction, when this transaction, if we choose to go ahead with this, comes to the board, only the independent directors will be voting. And at the end of the day, this will be also approved by the shareholders as well. So you are absolutely right.
Okay. Yeah, thanks.
Thank you. The next question is from the line of Manish Poddar from Nippon India AIF. Please go ahead.
Yeah, I just one question. So, what would be the cumulative losses or, is there any tax benefit up there because of this acquisition?
Sorry, I didn't get you, Manish. If you could repeat your question once.
Yes, I'm just trying to understand, what is the net worth of the company, and would it be right that, you have accumulated tax losses over here?
Cash loss?
As an accumulated losses which can be offset against the tax.
Will there be income company having it?
I'm just trying to understand what is the net worth of the company, if you can help me with that. Because I believe given the size and scale, and let's say if you take the cost of debt and tax rate, and the depreciation alongside, you will be incurring losses in, let's say, 2019 also.
Yeah.
So just want to understand where is the net worth, and do you have any losses which can offset the tax outflow incrementally?
So Manish, as I said, we are still undergoing due diligence. The data room will be available to us starting in the next few days. We will come back to you with the answer to that.